Hi everyone, good afternoon and welcome to my latest webinar on tips to save you pips with me, Rich Perry, market analyst at Hantech Markets. This one is called The Benefits of Trade Management, and it's the second one in our series that we're doing, a series of 4 actually, and hopefully you got a fair bit out of the first one, and this one is going to talk a little bit more about trade management and sort of emotion trading and stop losses, etc., etc. So hopefully you're going to get a little bit more of an insight into those 2 aspects. Now, let me just start. Right, before I get into this, you've got to see the disclaimer. Because the disclaimer is important, because I am going to talk about live market information today. And with that, you need to have read and understood the disclaimer, because that's the way it goes. But I will not be reading it. Okay. Little bit about me, as per usual. Bit of biog. Been in the market for 14 years, doing technicals and fundamentals, doing a spread of FX markets and also equity markets as well. And I currently do forex research with CFDs, sort of indices, and also gold, silver, and oil as well. So fair bit of sort of spread across the markets there in terms of analysis. And in terms of my my qualifications, I've got an STA diploma, which also gives me a little bit of insight into technical analysis, and hopefully that means that you will believe me when I sort of take you through the markets and trust me what I have to say. Okie dokie. A little bit of agenda first of all, just to sort of set out what I'm going to talk about today. I'm going to sort of do it in 2 halves really. Sort of a little bit of theory first of all in terms of trade management and how you can use trade management to benefit your trading. Hopefully won't take too long, maybe about 25 minutes, maybe half an hour, and then the rest of the webinar I'm going to be focusing on live market data, live market analysis. I'm going to look through all the forex markets and a few indices and some of the commodities as well. And as ever, if you've got any questions or have any markets that you're looking at, or you'd like help with, please don't hesitate to ask. I've got the chat box open here, so if you want to write in the chat box, then that would be a good thing for me, because then I can read them and sort of get them back to you as and when I can. But I'm going to start off with this little bit of sort of talking about trade management first of all. So hopefully towards the end you'll be able to get your questions across. So just in terms of what I'm going to talk about on the trade management side of it, I'm going to talk about first of all about emotion trading and the negativity that it can impact upon your trading account. Talk about stop losses as well, what stop losses are, how you can use them, and how you can derive them as well. And then I'm going to look at sort of managing your positions and into trade management and the benefits of that. So let's get into this now. Right. Just a little bit of background, really. What are the issues we're going to be looking at now? As I said, emotion trading is one of them. I've previously talked about the importance of having a trade strategy, and there are 2 sort of aspects that I talked about in that webinar, and one was emotion trading and how it can have a significant impact across your trading. And the second one is trade management as well. So trade management through use of stops, I think, can be an enormous positive from your trading. So emotion trading is a negative, whereas trade management is a positive. So, sorry, just one sec. I can't read that. Oh, sorry, am I actually on the wrong screen? Hold on, sorry. I think I've actually got the wrong screen. Yes. Whoops. Sorry, everyone. Had the wrong screen going on there. Right, okay. So yes, right. First of all, trade management. I hope you can all see the slides now. Right, trade management. Yeah, so it's I think it's a very important aspect of trading as well. So using of stop losses to help manage your risk, and also the flexibility of inter-trade management, sort of the aspect of sort of running the winners and cutting the losers. Because it's important to realise that when you actually do press the button on a trade, that's actually, I think, the relatively easy part now. The tough bit is making a profit on the trade, and not only that, more specifically, I suppose, making a profit that actually means something to your account. I'd say that if you can successfully manage your positions, you may not even need to be sort of getting your decision making right even much more than half the time, because I suppose if you are going to be making good profits in forex trading, you can use trade management to actually generate those profits on ideas that you're right on only just half the amount of time. So I think trade management is a very important aspect of trading. As I said just now, running your winners and cutting your losers is presumably a phrase you've heard before, but it may be difficult to put into practice because you have sort of the element of emotions in your trading as well. And I think emotion trading has a significant impact across your trading, and it's something that you need to sort of understand and learn how to manage, really, because psychology is such a key part of trading, and if you fail to keep a check on your emotions, I'd say that the likelihood is that you're going to see your sort of trading account being eroded quite quickly. So I'm going to focus on how to engage trade management into your trading strategy and how can it help your trading. And within this, I'm going to touch on a few technical indicators that can sort of help you to help to manage those positions. Right, I've just got a couple of questions here. Just let me just have a look. Right. Yep, sorry about all the initial technical issues. Right, what timeframes do you recommend when trading forex? Well, again, that is, I mean, if you attended my webinar last week, then you would sort of get to understand that. I mean, that's all down to your trading strategy, really, and the different aspects and how you look at the markets yourself, and what your attitude to the markets are, really. I mean, that some people will use 1 minute charts, some people would trade off hourly charts, 4 hour, maybe a daily chart. So it all depends on what you find yourself comfortable with, and ultimately what sort of how many pips you're going for in terms of your target and your trading. So I mean, in terms of my trading, I like to use hourly charts and daily charts, basically because my trading that I'm looking at, sort of the aspect, the targets that I'm looking out for, maybe across the course of 1, 2, maybe 3 days of trading, whereas maybe a trader that trades sort of intraday would be looking out for maybe sort of 5-minute charts, maybe 15-minute charts to drive your ideas. So it just depends on exactly what sort of outlook you've got on the markets. Right, let's get into this. Right, emotion trading. First of all, nobody is a perfect trader, so I mean, emotions have a big impact upon your strategy, and you need to understand that you're not going to profit from every trade that you make. And that is, I think, probably one of the most important things that you can learn in trading, that you're not going to profit from every single trade. You're going to make some mistakes, and therefore you need to just accept that and come to learn how to sort of use your mistakes and benefit from them, really, because obviously you're looking to not make the same mistake twice necessarily, and if you keep making the same mistakes over and over again, then there's obviously something wrong with your trading. So you need to be sort of learning from your mistakes ultimately. I would say ideally you need to be looking at keeping a trading diary, really, because you need to just note down why your trades went wrong, also why they went right as well, actually, because I think not only do you need to sort of try and not replicate why your trades went wrong, but also you're looking to sort of generate a consistency in your trading. So you want to find out why your trades went right for that in that instance, and you're looking to hopefully sort of generate that across all your trading. So I think keeping a trading diary is very important to that, and also it means that you can sort of take notes and maybe even tweak your trading strategy if that needs to be done, and make sure you, as I said, that make sure you don't sort of look to repeat the mistakes if they can be avoided. Okay, so in terms of emotion trading, you've got two different aspects really of emotion trading. You've got the emotions that are driven through winning trades, and the emotions that are driven through losing trades, really. But you need to understand that both can have a detrimental impact on your trading account, because, say for example, you get through a couple of winning trades, 3-4 winning trades, and you might sort of get complacent, and that can lead you to sort of putting on trades without the required thought process. Perhaps you might generate an element of arrogance also into your trading. And again, that could lead you to sort of putting on positions that are too great in sort of too big a size for your account. So you end up sort of over leveraging your account, and over leveraging is something that I'm going to talk about next time. But again, that is a very important aspect of your that you're trying to avoid, because becoming too arrogant in your trading, I think you could easily get burnt from putting too much risk on. So excessive risk, it basically is the culmination of possibly sort of getting these two emotions here, and can lead to costly mistakes, and especially if you've got a combination of the two. On the flip side of that is losing trades, and anger, for example, and feeling of revenge can lead you to trading in a rash manner without due consideration. So you need to avoid feeling resentful. I think if, say for example, if your trades go wrong, you need to avoid feeling resentful, and sort of the need, I suppose, to get even with the market. Because, say for example, if you're having a bad day, just let it go. I would say don't let a bad day get worse by just over trading and trying to get even, because at the end of the day, you're trading off emotions. You're not trading through your trading strategy. And it can have a big impact, as I said, on your trading account. Now, I'm going to touch on the perils of overtrading and over leverage in my next webinar, but it is a significantly, potentially a significantly bad impact on your trading account. So if you've made a mistake, or if you've got even a series of mistakes in a row, let it go, and just sort of shut down for the day, just switch off, and just come back with a fresh mindset in the morning, because it can lead to obviously your making significant mistakes. So yeah, trading out of anger and revenge is not a good idea, certainly because it basically just goes against your trading strategy anyway. So that's another aspect of it. Pride as well is also a big impact on your trading. I mean, say for example, you're running a losing trade, and you don't want the feeling of actually locking in a loss. And that is basically your pride taking over there. That's what I said earlier, is you're looking to run the winners and cut the losers. So if you've made a mistake, don't just run that loss and hope that it's going to come back. Trading on hope is never going to work. But that aspect of pride isn't certainly not an emotion that's going to help you. You need to understand your limitations. As I said earlier, you're not going to win every single trade. And certainly pride can have a big impact in terms of sort of not necessarily exacerbating your losses and sort of increasing them, but it can sort of prevent you from closing down a losing trade when you've made a mistake before you've even hit your stop loss. So you could come out with a smaller stop if you've closed out your trade, or a smaller loss if you've closed out your trade sooner, rather than running that loss, hoping that it's going to come better, and ultimately you do get stopped out. So just learn that pride is not a good emotion either. again, sort of don't wallow in your mistakes as well. I mean, depression and fear can certainly be debilitating to your ability to trade and press the button. I mean, I've spoken to loads of traders in the past who sort of go on a run of bad trades, and then they sort of I suppose lose all their confidence in their trading. But if you do find that happening, and this is very important, if you do find that happening and you do feel that you've lost the confidence to press the button on the next trade, then just again, go back to your trading strategy. Remember why you're putting on your positions in the first place, and it should be able to help you find some clarity in your thought, because you need to just sort of again just take a step back and just look at what you're doing and why you're doing it, because ultimately your trading strategy is hopefully a well thought out strategy, and it's going to help you if you just sort of take a step back, I think, momentarily. Perhaps you would therefore sort of in doing so make some tweaks to your trading strategy, but again, don't ditch your trading strategy altogether, because it is something that you've obviously put a lot of thought into, and ultimately it is around which that you're trying to sort of generate your trading ideas. So there is going to be some reason behind why you've got your trading strategy, and ultimately that's what you're looking to try and keep to. So all these emotions that you can get generated from both winning and losing trades have a big impact across your trading, and yeah, you need to just understand that as well. Right. Are you being compromised by your emotions? So basically, what can you do to prevent your emotions impacting on your trading? So ultimately, I suppose this is a bit of a summary really of that emotion trading aspect. So now trade management looks to reduce the emotional side of trading by managing the positions, but ultimately what you're trying to do is you're looking to be rational in your thinking. I suppose you want to, well, ultimately you want to stick to your plan. As I said earlier, you've got your trading strategy, you've thought it through properly, so you're looking to stick to that. And even if you make a little bit of tweak here and there, you're still looking to stick to your plan. And again, you're looking to be consistent. You're looking to be a consistent trader, and your ultimately your trading strategy will help to drive that. And ultimately, you're looking to keep your eye on the prize. Remember why you're trading in the first place, and try to stick to what you've thought out in the first place. And what I've got at the bottom here is a key tip. If you feel yourself getting overcome by emotion, take a step back, take a deep breath, and ask yourself, should I be taking this position? Should I be doing this trade? And hopefully that will help you in the end. Right, stop losses. I think stop losses are as I said earlier, very important aspect of trading. And I think you can certainly find a position in your trading for stop losses, because I think that certainly when you're first starting out in the trading world and you're maybe a novice trader, I think they have a very important part to play. Now, stop loss is an automatic order placed in the market that will close a position that you're holding if the market moves against you. Now, that stop loss that you've got in place, if the market is moving against you, a stop loss can prevent losses from spiraling out of control. And obviously, what you're looking to do in trading is have a finite amount of risk in the market on all your trades, in my opinion, certainly when you start out on your trading. And stop losses have a big part to play in doing that. Now, they are quite debatable. I think you can probably go on the internet and maybe on YouTube and find traders or gurus, I suppose, if they want to call themselves that, that are against stop losses. Now, I would say that is all well and good for them. They've probably been trading for a good long time. They've found out what works for them. But I can guarantee you that at some stage in their careers, they've been using stop losses, and they would be quite happy that they have done. I suppose that the more experienced you get, then yes, you can start to you can possibly think about not using stop losses. But I would say that if you're a novice trader and you're starting out, having a stop loss is incredibly important, because I guarantee you'll be putting on trades every now and again that are certainly mistake trades, and you will be very grateful to have a stop loss in. And so ultimately, what you're looking at for is using these stop losses to basically just to help your trading strategy really. And as I said, I think they're important. Again, I think they're important that if you're trading on a short-term basis as well, because the markets can be very choppy, can have an incredibly have incredible swings on them, especially at the moment. Volatility in forex markets is very high, and that can certainly have an impact on your positions. Now, unless you've got incredibly deep pockets, I would say that trading without a stop loss will have or could have a very crippling impact across your account. Not only that, you'll probably find that you'll sleep better as well if you trade with stop losses as well, if you're sort of holding positions overnight. I mean, say for example, just recently actually, in April, the ECB on the euro, the ECB was just starting out on quantitative easing, and the Federal Reserve was some way towards moving towards tightening interest rates. Now, the market obviously took that as being everyone was being short euro dollar. That was all well and good, happy days. A lot of people made money off those trades. However, in April, you had a huge turnaround on euro dollar. There was a big reassessment of euro dollar, and you actually got euro dollar rallying, I think, around about 700 pips or so in just around 3 weeks. Now, in that time, also cable rallied 900 pips. So if you'd been short on cable and euro dollar at the same time, then you would have and not had a stop loss on, you would have been absolutely roasted by those trades. So you need to just bear in mind that if you'd had a stop loss on, you would have certainly been sort of taken out of those trades. You would have, yes, you would have got those trades wrong. However, you would have been able to dust yourself down and look out for new positions rather than being sort of stuck in these positions that are going fast against you, and the stop losses just get the lack of stop loss has a massively debilitating impact across your account. So certainly recently in the last few weeks, having a stop losses on euro dollar would have been very important. Oh, sorry, I've actually gone too soon. So yeah, why have a stop loss? Now, I would say that without a stop loss, it can be very difficult to manage downside risk on a trade. Human nature can kick in, and you may, as I said earlier, sort of that old element of pride can kick in again. And you might not want to cut the position due to the size of the loss. You think, I can't take that loss, so you continue to run it, but then the trade could continue to go against you and the loss get bigger and bigger and bigger, and therefore you could have an enormous hole in your account. So if nothing else, just even for the potential downside, having a stop loss in place will help you sort of sleep better, and obviously also help you to manage your account much better. And also identifying the size for stop loss in a way can also be an important part of working out your risk per trade as well, and also the size of trade that you're looking to put on. Right. Okay. There are a couple of questions, I think, so hold on. Right. In terms of sort of when do you cut your losses? I mean, as I said, that's sort of down to using of stop losses, really. But I mean, what you can do is, as I said, is sort of you put your trade on, have a stop loss, and then if the trade starts to go against you, I think you'd be constantly looking at why that is happening. Is it something? Is it a change in market conditions? If it is a change in market conditions, then I would say that you're looking to close out that trade. I will focus on that in a little bit, but just bear in mind that if market conditions are changing, then and you're caught on the wrong side of that, you want to be looking to cut that position, and maybe you've already got a stop loss in place, but and as I said earlier, there's no point in sort of just letting that position run to the stop loss if you've made a mistake and the market's turned against you. and you're still running the position, you have got the ability to take that position off, and okay, you'll lock in a loss, but you'll be locking in a smaller loss than probably the main stop loss target that you had initially in place. Right, I'm going to talk very quickly about how you derive your stop losses now. So first of all, size of stop is important, and that's done from the number of pips in the market. So it can be due to your trading strategy, and it can be a function of your risk per trade. Now, in terms of size, I suppose it depends on the risk profile of the trader, really, and obviously you can have different risk reward targets on your trades. I mean, so for example, some traders do between maybe 2 to 1 to 3 to 1 in terms of profit to loss ratio. So therefore, if you're looking out for maybe 100 pips of profit, or maybe 150 pips, if it's 2 to 1 or 3 to 1, maybe you'd be looking out for a stop loss in the region of maybe 50 pips to the downside. So it would depend on the conviction, I think, you've got in your trade as to exactly the size of stop loss that you want to put on. Other aspects that drive stop losses can be technical levels. So key support and resistance levels taken from the price chart. So you're looking out for key turning points, key pivot levels, or even some traders will use Fibonacci levels as well. I mean, anyone who attended my webinars last year will remember that I talked about Fibonacci levels can be key pivot points on charts as well, and you'll see a lot of traders will use Fibonacci levels as their or to derive their stop losses. Now, I would say that this is very interesting here, is to give yourself some room on your positions. Now, basically, I'm saying that because I think that a lot of retail traders fall into the trap of putting stop losses bang on key levels, really, key supports or resistance levels. So round numbers are very popular for their key levels, and the big banks know that a lot of retail traders do that, so they would stick their orders in just underneath those levels and basically just hoover up all of those positions, all of those stop losses before the market turns around again. So that is a very frequent feature that you'll see in charts. Is certainly if anyone who sees the orders going through the market will see that stop losses are frequently hoovered up very quickly by the big banks, and they put their big positions on, and then there's a big turnaround in the market, and you wonder what has happened there. And I tell you what, it is the big banks knowing where you're putting your stop loss levels. So basically, I would say give yourself some room, maybe 10 pips, maybe 15 pips around these key levels, and that will, I tell you what, that will give you hopefully enough room, if that is the case, to avoid being hoovered up, because it does happen a lot. The other key tip I've got here is never to extend your stop losses. Now that is, I think, very important, because as I said here, it can be a key sign of emotion trading. So basically, if you see your trade getting close to your stop, don't be tempted to adjust it, because you need to be trusting your original analysis. There is a reason why you put your stop loss in place, and you need to sort of not get caught up in the emotion of the trade and getting it wrong and thinking, if only I could sort of move it around, then it'll be fine. It'll start to come back on side again. Well, it is a big trap that you would fall into if you started playing that game. And I've got it in here. Trust your analysis, because there is a reason why you put your stop loss in at that level, and it's a big sign that you're trading through emotion rather than trading with your head and through your trading strategy. So trust your analysis. So managing your positions, don't be idle in your trading. I would say manage your positions throughout the trade. Once you've pushed the button on the trade, that doesn't necessarily mean that's the end of the trade, because I think that managing your positions is a very or can be a very good way of just helping to generate your profits. And active trade management is, I think, a very important aspect of trading generally. Now, the thing I would say is that trading conditions can change during a trade. So once you put a trade on, say for example a bit of news flow comes out, that can change the expectations of the market, and you need to be aware of that. And I think you need to be quick to act on that. So managing your position throughout your trading is a very important aspect of that. Now, there are different aspects of managing your position. Say, for example, you've got, I'll go back to that position we had on earlier, say 100 to 1, a 2 to 1 risk reward ratio with a 50 pip stop. So you're looking for 100 pips of profit. Say, for example, you've seen your position move to 50 pips in profit. So basically, you're now looking out for, if you don't move your positions, you're looking at only a potential of 50 pips of upside towards your original 100 pip target, but you have a potential to lose 100 pips of downside if you don't manage that position. So you're effectively, your whole risk reward ratio gets completely skewed in the opposite direction. So that is not good. So in that instance, you've got several options you can do. First of all, you could adjust the stop to entry. So effectively, your risk reward becomes 50 pips of profit for 50 pips of loss. That is a pretty conservative way of doing it, I would say, because you're still risking 50 pips of profit for that lot, for the potential 50 pips of loss. So it's a 1-to-1 trade. Or you could tighten your stop even further to give yourself a guaranteed profit. So if you wanted to maintain that risk reward ratio of 2 to 1, then you would put your position 25 pips below where you are. So you've got 50 pips of upside, 25 pips of downside. That's twice the profit to your single loss. So that is a way. Or there is a third option, which I think is probably the most it would be, I think, the most active, and probably the one that professional traders would look to do, is to move both the stops and the profit triggers as well. So you're in 50 pips of profit. You could increase the profit target by another 50 pips. So you're effectively maintaining that 100 pips of profit target. And you could then move your stop to either entry or a little bit above entry, depending on how confident you are with this position going on. If you move it to entry, then I suppose you've got a free run at the trade. Maybe if you put it to a little bit above entry into profit, then you'd be sort of a bit more confident, I think, that the trade is going correctly. Ultimately, I think it depends, though, on the signals that you're getting from the market. You need to, again, I sort of said earlier that you need to be constantly looking out for market conditions. If market conditions are changing through your trade, perhaps the original argument for your trade being in position has changed. So, say for example, you're long on euro dollar, and then there's something negative for the euro that's come out, or some negative bit of news flow. Maybe what you'd want to do is ramp your stop up very high, basically, because if not, then the euro could turn around completely and you could lose all your profit. So that might be an option, because the arguments for you staying in the trade may well have changed. So maybe an idea to either take the profit off the table entirely, or if the position is not moving too much yet, you could sort of ramp it up reasonably close, but not entirely, just to give you that added option of still having a bit of upside potential if the market chooses to ignore it. But it depends, as I said, it depends on exactly the market conditions that you're looking at, as to exactly how you manage your trade. So if your signals remain strong, then you might want to stay in the trade. So therefore, you'd sort of increase your profit targets. Maybe keep the stop a little bit wider, just to avoid being chinged out on a trade. but you probably want to be sort of trying to stay in that trade for as long as possible. So it all depends on the market conditions at the time. And here we go. Here it says sort of market conditions are constantly changing. So you've got data, economic data that comes out, news flow, sort of rumours, I suppose, surrounding the Eurozone at the moment. Obviously, Greece are looking for their bailout money. News flow yesterday had a big impact on the euro and also equities as well. So the euro started to rally on the news that Greece was possibly close to a deal. Now that completely turned around a short euro dollar outlook because it sort of looked as though that Greece was potentially not going to be exiting the eurozone because it would be able to pay its debts. So therefore, the euro benefited off the back of that. That is to a certain extent still the case, but I'll talk you through that in a little bit. So running the basically in terms of changing market conditions, you're sort of looking to ask yourself, would you open a new trade now? Would you, if the market, if you're sort of putting a new trade on, would you still put that trade on? If the question is, or sorry, if the answer is no, then certainly if you're in a loss, then what is the point in running that loss? So you want to close that out. And the same is true of a winning position, really. So if you're in profit and then something happens to change the outlook, be ready to lock in that profit if needed. Now, I've got a couple of technical indicators here that I'm going to sort of briefly touch upon because I've talked about them previously in my technical webinars, which are all on the website, so you can look at them. But I'm going to talk about Bollinger Bands and parabolic SARS. Now, Bollinger Bands, I believe, are a decent near-term indicator. Here we go. Here's a set of Bollinger Bands around the euro. And what we've seen is the Bollinger Bands, once you start to move away from the Bollinger Bands, and certainly if you move through the moving average, then the argument being that chances are you're going to be moving back towards the other Bollinger Band. So that is, you can use Bollinger Bands in terms of volatility. So wide Bollinger Bands, you're looking for extreme signals. You're also looking for, here we go, narrow Bollinger Bands, this euro dollar in February through this sideways trading band, sideways trading range. The euro had low volatility where the Bollinger Bands came very close together, and then suddenly you saw it had a close outside, and then bang, it went to the downside. So you can use Bollinger Bands as you're trading, as a tool to manage your positions, and I think they're pretty good. Also, I like to use now parabolic SARS. I think parabolic SARS are very interesting when you have a trending market. Let me just change that to daily. Here we have cable, for example. We've turned the corner on cable. We had this long rally. Parabolic SARS chased this rally all the way up through April and May, and then the parabolic SARS got triggered, and we're now into a bear phase. So you're now sort of using these parabolic SARS tend to sort of act almost like a trailing stop, really, and they do work very well in trending markets. And we're beginning to get a downtrend formation in cable once again, and I think the parabolic SARS are again going to be very important in that. Right, I think I've got a couple of questions here. Talking about trailing stops. What's your ideal setup regarding trailing stops? Again, I mean, this it depends entirely on your risk reward and what your trading strategy is, and I think again it depends on certain aspects of your market conditions. If you see that the market conditions are potentially potentially turning around, then yes, I would use trailing stops because they have a tendency to, as I said, chase the market, and they're a good way of not losing too much on the downside if the market does turn against you. And parabolic SARS are an instance of a trailing stop on a technical chart. Obviously, the way you trade it on MT4 is you use the trailing stop function, but trading stops are a good idea, I think, in a trending market where you're running a position. Certainly, if you're running a position that's gone where you've extended your target and you're basically looking to run the winner, a trailing stop is a very good way of doing that. I'm assuming you're a swing trader with your busy position with Hantec, etc. I look to basically, I mean, my positions, as I said, my positions are sort of done on sort of daily basis. I don't like to trade too often because I like to trade with conviction, really. And I think that you can, when you're just starting out, you can run into the potential for putting on too many trades, and I'm going to talk about that next week with over trading and over leverage. But you get tempted into too many positions, and I think what you want to do is you want to run sort of trade the high conviction trades, and I think sort of doing it on an hourly basis and a daily basis, I think that sort of gives me more of a conviction trade than, say, for example, looking at 5 minutes or 15-minute charts. So yeah. Any good books on Bollinger Bands that you can recommend? I would say obviously John Bollinger, the chap who invented it. He's got lots of things on the internet that you can look out for. So I would imagine that he's come up with or he's written a very good book or study on Bollinger Bands. I haven't read it personally, but I would say go to the primary source of Bollinger Bands, which is John Bollinger, the chap who invented them. And yes, I do have a lot of time for Bollinger Bands. You do need to make sure that you use them in conjunction with other indicators, I would add, but I do think that they are very useful. Right, let's now look at the markets. Bit of time here. Right, this is euro dollar. Start off there on hourly basis as well. Right, what we've got on euro dollar is, if I zoom in on the daily chart, we had this bullish sort of turnaround candle yesterday, and that sort of came in conjunction with a bit of an upturn in the stochastics, really, which led me to suggest that perhaps we'd been sort of on a near-term bottom. I think it's going to be a technical rally that's going to fall over ultimately, because I've got marked in here. Actually, no, I haven't. That's annoying. But what I will do is change that, because that's the old one. 1065. 1065 through this trading period here is a very important resistance now. You could argue that's a top pattern. If it is a top pattern, which I think it is, that would actually give you a 400 pip downside target. So you're looking out for sort of 106.65 area. So we've so far got down to 108.18 was the low yesterday. But I think that now this 1065 level is going to be a massive overhead resistance. I think if you do get a technical rally on the back of these rumours on Greece sort of coming out to a deal, I think it's going to be short-lived. I think there will be a relief rally, but I think it will be sold into, because I see that nothing's really going to change. It's just going to kick the can further down the road, and ultimately I would imagine that the traders will be sort of run out of steam fairly quickly on the back of it. So I think that big resistance at 1065 would be an ideal opportunity. I mean, you've got sort of 100 pips worth of resistance on euro dollar now between 109.60 and 1065, and I would say that would be ideal in terms of your selling opportunities. Zooming in, this is the rally that we've had in the last couple of days. It's unwound the RSI, unwound MACD lines, and it's just, even now, it's sort of running out of steam already. The RSI didn't get to 70, so that would suggest to me that you're in negative configuration, considering the RSI has been consistently trading at or below 30. So I would say that rallies are a chance to sell on euro dollar now. And I think ultimately we're still in this bear phase, really. I mean, we had that rally. You had that rally, basically hit the downtrend and came off again. MACD lines crossed over negatively. That's a bearish signal. Stochastics, I think, are a near-term outlook, near-term signal that I think will unwind quite quickly. But I see that any rallies now back towards that 1065 is a chance to sell, because I think we're going to come back to test the lows again, ultimately in due course. And I think that the selling pressure is going to continue through the summer, and ultimately it's going to go lower. Right, okay, hold on, a couple of questions. Yeah, in terms of moving averages, yeah, I think that my personal preference is to use Fibonacci levels on my moving averages. So I look to use 21, 55, 89, and 144. I've just noticed I haven't got a legend on here, so let me just do that. That'll give you more of an idea of what I'm running. Okay, here we go on my levels. So yeah, I use Fibonacci levels. And in terms of euro going short, yes, I do agree with you. I think it will be going lower, but I just think that in the very near term, on the back of this possible Greece news, I think we might get a rebound that will be sold into. Sterling's interesting, isn't it? Because it had been sort of outperforming euro, but looking at this, you'd say sterling is a negative. That disappointing GDP data that we got today, let me just change the hourly. Disappointing GDP data that we got today had a sort of big bearish key 1 hour reversal, or bearish engulfing pattern, whatever you want to call it. And that sort of flipped you back into the negative outlook. But you're sort of finding resistance at lower levels on cable. Now, breaking down below 54.45, which was that key reaction low before the reaction sort of bounce, I think that now suggests you're beginning to pull into a new bear phase. And I would say that you've got the MACD lines crossing, stochastics falling, RSI falling. All of those are also below their lows, or their relative lows of early May as well. So I think that it's pretty bearish, and I think you now looking to sell any sort of strength in cable. It certainly seems as though the dollar has sort of turned the corner against a lot of these forex majors, and cable is one of them. And certainly the sort of the any rallies that you get, you had one yesterday, which from 53 figure, you actually got a high back to today of 53.85. So you got 85 pips of rally. Seems to be a bit common, a bit of a common theme. So that's 53.50, 54.37. So yeah, again, about 80 odd pips of rally in the last two rallies you've had. So if you do start to see a rally, maybe it will unwind by that sort of figure, sort of maybe 100 pips. But I would be looking to use that rally as a chance to sell. I think cable will be going lower. Bill saying about cable could be heading for 150. Wow, 150. Okay. Yeah, why not? It certainly looks to be. That is a massive sort of old pivot level now. So 150 would be, I think, where you're coming back towards. You've got to negotiate this first support 50.80, which is your big resistance. Sorry, big support on the way up. But you've now, it's now having broken that uptrend, you've turned the corner. I think you're now going to build a sequence of lower highs and lower lows, and I think you're using any rally as a chance to sell on cable now. Just across the board, it looks pretty bad. Japanese yen. Now, this is an interesting one. Obviously, Japanese yen has broken out massively in the last few days. I have sort of noticed that we're getting these, still there. We had this rally today, early morning rally to a new high, absolutely. So that's another rally high you've got, and another lower high on the MACD and the RSI on the hourly chart. Now, I think that's really interesting because that is a bearish divergence across the board. In the last 3 days, we've had several sort of instances sort of confirming this bearish divergence in place on MACD and RSI, and I think that would suggest you're beginning to run out of steam. Now, the question is how I mean, will it have another leg higher before it comes lower? It's a difficult one to say, but it's a big warning sign, in my opinion, that running sort of, especially running naked short positions, i.e. without any stop losses or anything like that. Sorry, naked long positions on this dollar yen chart without a stop loss on the downside, I think is a big risk at the moment. I think with it, in light of these sort of bearish divergences you've got on the breakout level. Interesting that if you measure the width of that band on the daily chart between 118.30 and 122 figure, gives you 125.70. So does it? Yes, it does. Sorry, just questioning my math there. Yes, it does. 125.70. So that is ultimately a breakout target, but it'll be interesting to see if that bearish divergence starts to weigh on the sentiment, because I think that may well do. But you need to, just bear that in mind if you're running long positions on dollar yen. All right, let's look at Aussie, because I've drawn in just now. Big downtrend channel on Aussie on the hourly chart, as you can see. Big downtrend channel, consistently breaking through the supports. You would say, obviously, bearish configuration across these moving average, momentum indicators, moving averages all falling in bearish sequence on the hourly chart. You'd say that the RSI is now oversold again. It seems to sort of come back to oversold, and then you get this minor rally situation going on. Certainly scope for a near-term technical rebound, but I'd be looking to sort of sell that into strength. So you'd be looking out for sort of resistance levels that come in sort of 76.70 up towards 77 figure. Looks fairly decent. That's 70 pips of resistance. So you'd be looking out for this sort of hourly RSI to unwind back towards that 50 odd level. MACD lines to unwind a little bit, stochastics to unwind a little bit, and then probably you'd be going again to the downside, because it certainly looks as though you're going to be coming back to test these lows again on this chart. Across the board, bearish configuration on the daily chart. I'll just look at Kiwi. Sorry, Bill, just give me 1 sec. And then I'll look at the CAD. Kiwi, oh, it's gone. Interesting. It has gone. Because I looked at Kiwi today, it has gone, broken down, because it was sort of trading up around here when I wrote my morning report today, and I was thinking, well, it doesn't really look as though it's going to rally, and I think across the daily chart, all those momentum indicators were bearish. Everything was pretty much pointing to a breakdown on Kiwi, or certainly a test of the lows, and it has now sort of broken down. Really interesting breakdown that is, because that is a massive breakdown. God, see how far this goes back. Yeah, you're looking at sort of 2011 levels now, 71 figure area. But really, you're not got a great deal of support until you hit that big 2010 low below 66. Wow. Yeah, it certainly looks like there's further downside, but obviously it's a bit. No, is it really? It's not really getting that stretched yet. Still further downside on that RSI potentially. So yeah, this could run. Actually, thinking about it, that could run. So look to use any sort of retracement. Yeah, indeed. But that Kiwi move was on the prospect of a rate cut. They haven't done it yet, obviously. But yeah, the RBNZ is thinking about a potential rate cut if pricing pressures suggest it, they said. So yeah, not even with a rate cut yet. So it'll be interesting if they do actually cut rates. I mean, that would certainly suggest that the market is sort of factoring in now that they're going to do a rate cut at some stage, you'd imagine, certainly with that breakdown. I mean, having said that, the dollar is very strong at the moment. So that is a big driver of it. And I did sort of talk today about the fact that it's sort of a similar sort of situation with dollar yen, really, sort of this sideways trading band and then breaking out. So this breakdown could well have some legs on it, as it has had on dollar yen. Right, I will now look at CAD. Now the question being why I don't do CAD on the daily basis. I do 5 charts on my daily chart, my daily analysis every day. Do euro dollar, sterling dollar, dollar yen, gold, and oil, WTI oil, and I sort of do a chart of the day, which occasionally I do dollar CAD. I admit I haven't done it for a while though, and maybe that's to be rectified. But yeah, I mean, look at that, nice, very strong uptrend on that hourly chart. That's good. That is good. Configuration is very positive as well now. Hourly RSI finding support nicely above 50. So every time it gets back towards 50, it gets bought again. MACD lines are as well configured bullishly on the hourly chart. It's perhaps a little bit stretched. So you've just had this sort of hourly correction actually today. It certainly looks there's a pretty big correction, but I think it's more of an unwinding move than anything else. So I'd say you'd be looking at sort of buying that in towards your support. I mean, there's a great element of support around that 24.40 now, although that's 60 pips ahead of where you are. So I'd say that any sort of move back towards possibly that low around 24.60, so maybe 24.40 towards 24.60, I think that would be ideal. You'd probably see the RSI on the hourly chart also unwind. Yeah, it certainly looks very strong on the CAD. Right, let's look at gold. Has gold broken down? Oh no, rallied. It's rallied in the past hour. So has something happened in the past hour that's gone dollar negative, because that's the CAD that's reversed. That is the gold chart that's rallied. Interesting to see if anything's happened in the last hour that's gone dollar negative. Pending home sales, maybe. Let's see what happened on pending home sales. Pending home sales was positive actually. So I don't know. That's odd. That is odd. But yeah, this breakdown on gold I thought was going to then drag it back towards the low of the trading band, but it's sort of rallied since then, interestingly. I mean, is that the test? That is the question. Is that the test of the low? 1180 spot 50. I mean, the sort of band of that support comes in around 1178, 1179, so only a couple of bucks away. And then you would also argue, looking at the momentum indicators, still range bound on the MACD lines as well. The stochastics falling away and not great. But if this closes here, that's another doji candle, which would suggest to me that perhaps there's something. So I mean, that suggests uncertainty. Doji candlesticks suggest uncertainty in the move. So yeah, that could be that it's sort of looking to find a low maybe around the bottom of the band again. But I'm not expecting necessarily the band to break lower. Although, having said that, Kiwi's broken down, dollar yen's broken up, euro's fallen over, cable's negative. All these charts are dollar strength, showing dollar strength. So dollar strength should theoretically drag gold price lower. But yeah, at the moment, gold is still range bound. But obviously, we've had some negative candles in the past couple of weeks that have sort of coincided with that dollar move. So obviously, it is moving on the dollar, and you need to be careful of that. So just I'd be a bit wary about playing unless you find some serious support coming in, and perhaps even a buy signal. Then just be careful with that. But certainly, the last hour or so has helped. So yeah, right. Just do the DAX very quickly. One last chart, because I know that I'm sort of running over now. Big support on the DAX at 11,620. That is still in place. I think that's sort of like I'd call it a pivot band, because it was arguably the old neckline support, but then you started finding the resistance at 11,710, and I think you've got this band now of support between sort of 11,620 and 11,710 on the DAX. Again, last hour or so, we've just sold off sharply on the DAX, interestingly. So something must have happened. I don't know, because I haven't looked at my news flow. But I'd be very surprised if it's not to do with Greece, actually. Anyway, could be. But yeah, in terms of DAX, I think range-bound consolidation, but quite volatile. And I think, again, once more, we're seeing this fairly volatile move on the DAX. The last few weeks on the DAX have been so volatile, but not really gone anywhere. You've seen all these big, solid candles, higher, lower, and not really finding any real direction. And you've seen the momentum indicators actually start to sort of become neutral. So DAX is a difficult one to call, and I think it will certainly have big mover on any announcement of a Greece deal. But I think at the moment it's just, again, unwound that yesterday's rebound. So big pivot level I'd see on the DAX around 11,620, and if you sort of close decisively below that, theoretically you're probably coming back towards the next sort of support band, which comes in around that 11,400, just below 11,400 level. So yeah, that would be what I'd be looking out for. So if you closed below 11, say for example that low there, which was a spike low, but 11,586. So if you closed in the 11,000 sort of 580 below there, I'd say yeah, perhaps you'd start to see the DAX correcting lower again. But for the meantime, it's still holding onto this sort of pivot band. Anyway, that's it really. Thank you very much for listening to me today. Gone to the wrong one. And you can, any questions, please email me on marketing@hantechfx.com, because I'm perfectly happy to speak to you and sort of help you out in anything you've got on, and hopefully that will help you to just make some decisions. At HantechRich for my Twitter handle. And our research is on the website at hantechfx.com/market research, and it's all there. So yeah, that's where I post all my stuff. So I wish you good luck in all your trading, and thank you very much for listening today. It's been a good turnout. Thank you very much for coming on, and please join me next time for the perils of over trading and over leverage, because I think that is very important as well. So thank you very much, guys, and I'll speak to you next time. Cheers.